In this video, I've put a list together of 7 of the best Vanguard funds that are currently on offer. Choosing funds can be complicated, especially if you're just starting investing. So here, I'm going to put all the relevant information together to enable you to make comparisons so that you can make the best choice for you. The funds listed will primarily cater for those who are after growth, although if you stick around to the end, a couple of the funds featured are for those who are retired or close to retirement, and those who may be a little bit more cautious in investing and have less of a tolerance for risk. For illustration purposes, I'm going to use the Vanguard website. This website is really useful and has lots of information that will help you make comparisons. All the funds that are featured in this video are low-cost, passive index funds. This keeps things simple and means that once you've chosen the fund that suits your circumstances, you can just invest in that fund on a regular basis and hold it for the long term. In these passive funds that we talk about today, everything inside them is arranged in accordance with market capitalization. For instance, if Microsoft takes up 4% of market capitalization in relation to the index, then that will be replicated in the fund. Changing the proportions of a fund to try and beat the market is something that an active fund or an active investor would do. However, today we're here to talk about passive investing, so we're not really going to touch on this subject in too much detail. The Vanguard funds featured in this video are either mutual funds or ETFs. Vanguard's ETFs have more availability elsewhere than their mutual funds if you were looking further on the Vanguard website. ETFs and mutual funds are very similar in many respects. Both consist of stocks of various companies, often across various regions of the world and in various sectors depending on what the characteristics are of each fund. However, ETFs are traded on the stock market and are available to buy at any time of day for the price given at that time, whereas mutual funds are priced daily. When you purchase part of a mutual fund, you're buying a proportion as opposed to an individual share, and therefore there's not a full share price to reach before you make a purchase, although minimum purchase levels might apply. So if you wanted to pay £200 into a mutual fund on a regular basis, you could set up your direct debit and just arrange that, and that would be the end of it. However, with an ETF, there will be a share price. So in the same example, if a share price was £80 for the ETF and you had £200 to invest, that would enable you to buy 2 stocks for £160, and the remaining £40 would sit in your cash account until you had enough funds added to afford that next share. That said, certain investment platforms such as Trading212 and Invest Engine allow you to purchase fractional shares in ETFs. Just a couple of things I'd like to mention before we move on to these 7 funds. The first is that all the funds I'm going to show you today come with accumulation and income options. Accumulation is another name for reinvesting dividends automatically, and income or distributing means that the dividends that come from the fund are paid directly to you. My preference is the accumulation versions, meaning that the dividends just get automatically reinvested and I haven't got to do anything. You might prefer the distributing option if you want the dividends paid to you, for instance, if you're going to use those dividends as an income. The nice thing about accumulation for me is that if my dividends are paid back into the fund automatically, I haven't got to worry about dividends being paid out, not having enough money to buy the next share and having to wait to deposit that money. And the second thing to look out for is the ticker symbol. Ticker symbols are exclusive to each individual fund to help you identify them. There will be a different ticker symbol for the accumulation version of a fund and the income version of a fund. I'll point that out to you as we go along in this video. So let's get into this, and let's start off with the first fund, which is probably the most popular fund of all. The S&P 500 features the largest US-based companies. It has 503 stocks presently, and those include Microsoft, Apple, Nvidia and Amazon. The fund has a very low OCF of 0.07%. What this means is that for every £1,000 that you invest in this fund, you get charged 70p per annum. The OCF, or ongoing charge figure, is the fee that the fund manager requires of you to administer the fund. Historically, the returns that this index has been giving you have been very hard to beat. The famous investor, Warren Buffett, once stated that investing regularly in this fund and holding it forever is what most investors should be doing. Here are the ticker symbols in relation to the accumulation version and to the income distributing version. Presently, I own a distribution version in my Vanguard ISA, as at the time of purchase the accumulating version wasn't available. I intend to do regular updates on my Vanguard Stocks and Shares ISA and my Trading212 account, so look out for these. And on that note, I would really appreciate it if you give me the thumbs up in this video if you like what you see, and to consider subscribing and turn on your notifications so you will know when I've posted new content. So number 2 on my list is the Vanguard FTSE Global All Cap Fund. This is the only mutual fund that we feature here today, and it really is truly a whole world fund. At present it has 7,129 stocks, and these stocks consist of small, medium and large sized companies across the developed world and also within the emerging markets. I'll talk a little bit more about emerging markets later on. This provides excellent diversity. which should be a key priority of being a smart investor. Being diversified across the world means that if economies and companies in one part of the world do badly, hopefully you will catch the growth in another part. We can pick stocks going on past performance, but that should not be a sole reason for investing in something. And past performance really is irrelevant data, as we cannot guarantee that the same thing will happen in the future. Even though this is a truly diverse global fund, you will see that 62% of stocks are still concentrated in the USA. You might feel that investing in this fund is all you need to do, and there's no need to add the S&P 500 or any other funds to it. A lot of people do this because they like to chase the performance of the S&P 500. But by doing so, you might overexpose yourself to the US and the larger companies, as both funds have significant US representation. And by concentrating your portfolio towards the US means that other parts of the world have their exposure reduced in your portfolio. The ongoing charge figure for this fund is low at 0.23%. And here are the ticker symbols depending on whether you're looking for the accumulation version or the income version. As this is a mutual fund, it won't be found on many other sites other than the Vanguard site, but it is on Hargreaves Lansdown's investment platform if you are looking for an alternative place to purchase. Moving on to the next fund, which is the Vanguard FTSE All World UCITS ETF. Again, this is one of Vanguard's most popular global funds, but on this occasion, this is an ETF as opposed to a mutual fund. Like the FTSE All Cap, this is investing in companies across the globe, including those in the emerging markets. But the main difference this time is that this fund only concentrates on large and medium-sized companies as opposed to the small caps. It is argued that the large and mid-cap companies are less volatile than the smaller ones, so you may see a little less price fluctuation if you invest in this one as opposed to the All Cap. Presently it has 3,672 stocks and another low OCF of 0.22%. Just like the last one, this one includes the largest companies across the world, mostly coming from the US, which again accounts for 62% of the fund. The Vanguard website allows you to delve into the data of which companies are covered in these funds. And if you dig into this information, you start to realise that you're now an actual shareholder in Microsoft, Apple and Amazon from purchasing this fund, albeit a small shareholder. Here are the ticker symbols, depending on whether you're accumulating or income. So moving on to the next fund, which is the Vanguard Developed World UCITS ETF. This fund has 2,133 stocks at present, and those stocks relate to mid and large cap companies. But this fund is a little different to the previous two global funds I showed you, as it excludes emerging markets. The developed world is the US, Europe including the UK, Japan and parts of Asia such as South Korea and Singapore. The ongoing charge figure for this fund is 0.12%. This is one of the reasons why I choose this fund for my portfolio, as that charge is very low. Some might argue that this is the only fund you need, and you can disregard emerging markets. However, excluding this category could be a mistake, given the potential for growth over the next 5, 10, 15 years in countries such as China, Brazil and India. You cannot predict what's going to happen in the future, and need to decide what you think is best for you. Maybe the more you diversify, the better chances you have of catching the growth wherever it is in the future. Remember, I'm not a financial advisor, and this is a financial educational video and should not be construed as financial advice. Consider seeking help of a suitably qualified professional in circumstances where you're unsure of investing. Moving on to Fund 5, which is the Vanguard Emerging Markets UCITS ETF. This fund has 2,113 stocks at present in large and mid-cap companies in countries such as China, India, Brazil and Taiwan. Its OCF is a reasonable 0.22%. Here's the ticker symbol for the accumulating version of emerging markets, and here's the ticker symbol for income. I personally just choose to have small exposure to this fund in my portfolio, about 3% in my Trading 212 general investment account. I will be opening a Trading 212 stocks and shares ISA in the near future, where I expect to have similar exposure in this fund. I'm not saying that 3% is the proportion of exposure that you should have in your portfolio, by the way, but any more for me would be to over-concentrate this fund in my portfolio. I also need to take into account my shorter investing timeline, which is why some of my portfolio consists of bond funds. For you need to decide for yourself how much exposure you want to this emerging markets fund, if any, but remember that a key objective of yours should be diversification. Talking about shorter investment timelines takes me nicely onto this next fund, which might be a good choice for retirees or those close to retirement. So the next fund we're going to talk about is the Vanguard FTSE All World High Yield UCITS ETF. That's a bit of a mouthful. This fund consists of 1,860 stocks at present, but not from the likes of growth tech companies like Apple and Microsoft, but from dividend-paying companies such as JP Morgan, Exxon and Broadcom. The companies in this index concentrate more on paying their shareholders dividends, rather than growing a company. Maybe because the company has reached its optimum size, and utility companies are often an example of this. Again, US companies make up the largest proportion of this index at just shy of 43%. You also get the option of accumulating an income in this fund, which seems strange as you would think you'd be invested in this fund to get the income. I guess if you choose accumulation, you are betting on dividend paying companies doing better than growth companies going forward. This might happen sometimes if growth companies fare badly in difficult market circumstances. For me, this fund is an income fund, and not a fund that I would personally choose to fuel growth in my portfolio, but that's just my opinion. The OCF, although still low, is the highest of all the ones we featured in this video at 0.29%, and dividends are paid quarterly. The current dividend yield is advertised as 3.48%. This yield is not guaranteed and you could get less. Companies within this index may choose not to pay their dividends. However, this risk is diversified away given the large amount of other companies in this index. You would have to have a significant investment in this fund to give you a workable income. For example, a £10,000 investment in this fund with a dividend yield of 3.48% will give you £87 per quarter. You can check on dividends distributed in the fund's pages. All of the fund stocks are mid or large cap, and this includes emerging markets. It is worth mentioning here that dividends are not free cash, and that money is taken from the value of the company. The removal of this value would therefore reduce the share price and stifle growth, so this is worth considering if you are investing for growth reasons. I spoke about having bonds in my portfolio just now, and whilst on the subject of funds more suitable for retirement, I thought I would show you this next fund. And this fund might also suit a more cautious investor who has less of a tolerance for risk. So the next fund we're going to talk about is a bond fund, and it's the Vanguard Global Aggregate UCITS ETF. Just like the funds we've spoken about so far, this fund tracks an index, but on this occasion, rather than tracking equities, it's tracking global, investment grade, corporate and government bonds. 10,884 at present to be exact. The ongoing charge figure is very reasonable at 0.1%. The bonds in this fund are high quality, meaning that credit risk is reduced, namely that the bond issuer has not paid back their debts or fulfil their obligations to pay the regular interest or coupon payments. Bonds tracked in the index are also of varying durations, and this adds extra diversity to your portfolio. This fund might not be relevant to you if you're a younger investor just looking to get as much growth as you can into your portfolio. But if you'd like to reduce price volatility market risk in your portfolio as a more cautious investor, or are nearing retirement and want more consistency and stability, then a global bond fund could do the trick, as adding bonds with equities in varying proportions is known to achieve this, given that these asset classes are negatively correlated. This means that, in principle, as the price of one asset falls, then the other should rise or fall less harshly. It should be noted that this is not always the case or guaranteed, as can be seen in the last couple of years where both bonds and equities fell sometimes heavily in unison. 60% equities and 40% bonds is often touted as a good proportion for cautious investors, as bonds provide lower returns than equities, so if still requiring growth, you would have that 60% equity proportion to do the work. So in these circumstances, you might choose 60% in a global equity fund and 40% in a global bond fund. Or maybe even higher proportions in bonds if you're already in retirement and your equities have already done the work over the years and you just want to consolidate what you have. I will leave bonds for now in this video, as this is a big subject for another time. I just wanted to make you aware that these funds exist and that you might want to use them to accompany the equities in your portfolio. So there you have it, 7 funds for you to take away and look at in more detail. Whatever you choose, all these funds are designed to track an index over the longer term and provide reasonable returns. So investing in them regularly and leaving them alone over the long term is a sensible thing to do. As I mentioned earlier, be careful if you decide to purchase more than one equity fund, as you might overweight your portfolio to a certain region, company, etc. And we used the example earlier of overlapping a global equity fund with the S&P 500 and overweighting your portfolio towards the US. I'm not saying this is a bad thing, by the way, but just something that you should be aware of when you're constructing your portfolio. And finally, try to purchase whatever fund you've chosen, either in a stocks and shares ISA or a pension, to get the different tax benefits that each provides. So I do hope that you've enjoyed the content of this video today and that you'll consider giving me the thumbs up. Please also consider subscribing to my channel and to turn on your notifications so that you're aware when I post new content. Once again, thanks very much for watching.